Happy New Year, everyone. Welcome to our very first 10 seminar, Tuesday afternoon networking seminar in year 2023. Hi, my name is Coco Tan. I'm a full-service real estate agent with Keller Williams Realty in the San Francisco Bay Area. Today, we're going to talk about 1031 exchanges and maximizing your profits, new for 2023. So, what is your New Year resolution? Making more investments and building wealth, or perhaps just learning more? Be sure to stay up to date with what's happening in the real estate world by adding me on WeChat and subscribing to me on YouTube. I have the QR codes on the wall that you can scan straight off your computer screen. You might already be familiar with the concept of 1031 exchange if you already own an investment property, or if you joined our previous seminars. But the law seems to change every year. So what happened last year and what's going to happen this year? To give us all the answers, we have invited our expert, James Callejas, to return as our guest. James is the Vice President of National Accounts with Investment Property Exchange Services, Inc. He is responsible for business cultivation and development nationwide. James has conducted thousands of seminars on different topics related to real estate, taxes, estate planning, and personal property. He teaches continuing legal education and continuing professional education to attorneys and CPAs. James will give us a more detailed explanation of the rules of the 1031 exchange and explain how you can take advantage of it to build wealth. He's also here to answer your questions. So if you have any, please type them into the chat to a co-host, and they will be gathered and answered after the initial presentation. So James, thank you for being here today. Happy New Year.
Happy New Year, Coco. Glad to be here today. And I think things have changed since the last time I was on here, because now I wear these glasses because I guess my New Year's resolution is being able to see things that are close to me. I guess this happens when you get older and wiser.
Oh, that's great. We all want to be older and wiser. Now, the floor
maybe the wiser part, Coco.
Older is for sure. All right. So the floor is yours, and so please take it over.
Sure. So I think a lot of the things that Coco said was absolutely correct. My job is to go out there and help people create wealth within their real estate portfolio. And the 1031 exchange is the best weapon that exists when you're looking to do something like that. So what I want to do today is really go over what it is, just to make sure, and very quickly do that, of what the 1031 exchange is, why we do the 1031 exchange, what's going on in the 1031 exchange market right now, and what we see as trends going forward, and what we need to do in order to ensure that you have a successful 1031 exchange, and some of the recent changes, one that actually happened this morning, which is very exciting. So happy New Year, happy 2023. Really quickly, you're going to hear it quite often, what a 1031 exchange is, or you might get the question, what is a 1031 exchange? So I like to keep things very simple. So when anybody ever says anything 1031, you know automatically this is only for investment property. So the 1031 exchange is the Internal Revenue Code that allows you to sell and buy investment property. And if you follow the rules and guidelines that I will review today, you'll be in a position to pay absolutely zero in capital gains tax. And this is huge because when you look at things, especially in the state of California, let's really quickly look at the tax scenario, what you would pay on the sale of an asset. Number one, you're going to pay four different people. You're going to pay Gavin, you're going to pay Joe, you're going to pay Sam, and you're going to pay Barack. So when I talk about that, you're paying state tax, federal tax, depreciation recapture, and the Healthcare Act. And when it comes to the state of California, you get hit the hardest. We're in the state of California, so anywhere between 9.3 to 13.3% you're going to pay on every dollar of gain. When it comes to federal tax, unless you make absolutely nothing for the most part, you're going to pay either 15 or 20% or a combination of two, depending upon where you lie that year in terms of adjusted gross income. And the depreciation that you've claimed throughout the life of owning that property, Sam recaptures 25% of that. And every dollar of gain, once you exceed a certain threshold, you're going to pay an additional 3.8% to healthcare. So at the end of the day, when you're looking at a California real estate, and you're selling an asset and you're looking to cash out on this investment property, you are going to be losing about 30 to possibly as high as 40% of the appreciation that you made on that property. So it is a really huge tax hit that you're going to take anytime you are selling a piece of investment property with gains in the state of California. So again, the 1031 exchange is the tool in real estate that allows you to sell and buy investment property, deferring all of those taxes that I just mentioned, which are really, really huge. And so most people think, oh, okay, so we do a 1031 exchange not to pay the capital gains tax. That is not the case. If you do not want to pay the capital gains tax, the strategy is very simple. Do not sell the property. If you don't sell, you are not going to pay capital gains tax. So then people say, okay, then why do you do the 1031 exchange? And I say there's a variety of different reasons. I mean, we could look at people who own investment property anywhere throughout the United States. And I can tell you one thing, there's a lot of common factors on why people unload investment properties. Number one, if you've been a landlord for a long period of time, you may be that person that's tired of the tenants, the trash, the toilets, the termites, the taxes. I've been a landlord for I think 18 or 19 years now, and I really don't remember the good tenants as much as I remember the bad tenants. And the bad tenants can come on a number of different levels. The ones that mess up the property, the ones that don't pay the rent, the ones that just break all the rules. As a matter of fact, I have an investment property right now, and the HOA rules say that you cannot have a trailer in front of the house. And what they have really doesn't look like a trailer to me, but the HOA doesn't care what the tenant says and what I say. The HOA has their rules, and the bad news is if my tenant doesn't follow the rules, I have to pay. So, I mean, when we look at investment properties and why we do a 1031 exchange, for me, it might be because I'm tired of dealing with the tenants, the toilets, the trash, and all of the bad things that come as being a landlord. And maybe I want to go into another piece of investment property that I don't have to manage. A lot of people, especially in the state of California, want to unload their investment property. If we just look at Oakland, if we look at San Francisco, if we look at Berkeley, where there's been rent control for many, many years, you have a lot of tenants that have been in there. And I got to tell you, in San Francisco, my parents own investment property in the city. We have one grandfathered in tenant that is paying less than $1,000 on a unit, a 3-in-1 unit in Noe Valley. Those are ridiculous numbers, and you really can't do much about it. So when you're talking about investment property, there's truly 4 reasons why we own investment property. Number one, cash flow. And in the state of California, when you're subject to rent control, sometimes cash flow really doesn't make sense and you really can't change it. Number 2, the write-off for investment property, it's depreciation. Now, here's how depreciation works. There's 2 types of depreciation, one for residential property and one for commercial property. Residential property, you can depreciate over 27 and a half years. Commercial property, you can depreciate for 39 years. Now, if you've owned a property longer than 27 and a half years and it's residential property, you no longer have that write-off. But here's another thing that most people don't realize about depreciation. Let's say like I've owned it for 15 years and I still have 12 and a half years of depreciation. I cannot depreciate appreciation. So I only can depreciate the original value of the structure. So even when there is depreciation left, sometimes it isn't as much as people think. And the reason why people like depreciation so much is you have income coming in and you're going to pay tax on that. The way to mitigate some of that is to have a write-off. Depreciation is that write-off. Number 1, it runs out after a certain period of time. Number 2, you can only depreciate the original purchase price minus the value of the land, so you may not have as much depreciation as you think. So we've gone over 2 of the 4 reasons why we own investment property. The cash flow, and we know that in the state of California, that can be very poor. Number 2, the depreciation. We also know anywhere in the United States that you can run out of that after a certain period of time, and it may not be as much as you thought originally because it does not factor in the appreciation. Number 3, amortization. Now, a lot of people buy properties with a loan, and by paying off that loan, you're building up equity. Amortization is that process. Well, when you've paid off the property completely, there is no more buildup in equity on paying down the loan. That's done. So poor cash flow, depreciation running out, a fully amortized asset, Fourth reason we own investment property, and this one's the most common in the state of California, is appreciation. And appreciation is great in so many respects, but at some point in a lot of different scenarios, specifically in the Bay Area, there's been just so much appreciation. The return on that investment in terms of cash flow no longer makes sense. And it might be a way to utilize the 1031 exchange in order to get better returns on the investment, new depreciation schedule, get out of rent control, get out of active management of the real estate asset. So when we're looking at a 1031 exchange and why people do 1031 exchange, I think it's different for everybody. Like myself, maybe I want to get into something that's passive. There are passive investment properties that are very popular that someone like myself can get into. Number two, I could get better cash flow in a different state. I leave the state of California. I could buy multiple properties, get better cash flow. Number three, I could re-leverage into something else because I built up all this equity and perhaps I'm going to diversify my real estate portfolio. And through the 1031 exchange, not only will I preserve all my equity, but I could leave the state of California, keeping all the equity intact, buy multiple properties, leverage out into different areas. And now I can have a diversified real estate portfolio throughout the country. And I can mix up that product type. I don't have to stay in residential when I'm selling residential. I could go to commercial property or vice versa. And I can go and do this on different depreciation schedules, increase cash flow, future appreciation and growth. These are the reasons why people do 1031 exchanges. And those are just the reasons off the top of my head. I can tell you that last year, well, 2021 and 2022, there were so many different people that said, James, you know what, I'm just tired of the game. I got so much appreciation and I'm looking to retire because now I can actually work out of my house and I don't want to live in California anymore. I want to live somewhere else. And some of the strategies were, let's sell the investment property, let's do the 1031 exchange, and let's buy that dream home. Let's buy that vacation home through the 1031 exchange. Here's what you got to do. You sell the investment property, do the 1031 exchange, buy the replacement property, and treat it as investment property initially. And it doesn't have to be that long. And then eventually move into the property or treat it as a vacation home. So again, let's start from the beginning. 1031 exchanges where you sell and buy investment property. If you follow certain rules and guidelines, you'll be in a position to pay zero in capital gains tax. But the true reason why people do 1031 exchanges is not to not pay the capital gains tax. Yes, that's a good benefit, but that's not the reason. The reason is this investment property no longer makes sense, and you're at a point in your life where it's time to unload that asset, preserve the equity through the 1031 exchange, and get a better piece of investment property, a superior piece of investment property through the 1031 exchange to mitigate the problems that you had with that property. I got to tell you, I have a lot of clientele that sell properties just because the property's old and there's always something going wrong with that property and they're tired of it. And especially after these rains, there's so many people that have said, I should have got rid of the property. The roof is just a mess. Now it's created more damage. A tree fell on my property. It's been insane the number of calls that I've received where people were asking what they can do with this asset because they're so tired of the problems that they have in certain areas, or because the property is old and decrepit, or what have you, but they don't want to pay the capital gains tax. And what they thought was a cash cow really wasn't. And now they can unload that asset through a 1031 exchange and buy a superior piece of investment property. Okay, so we talked about what a 1031 exchange is, why we do 1031 exchanges. And again, I can go into more reasons, but I think you guys get the point that there are reasons why the current property you have no longer makes sense. You don't want to pay the capital gains tax, but you want to get a better piece of investment property somewhere else for whatever the reason may be. And the best way to do that is through the 1031 exchange, because you don't have to pay Sam, Joe, Barack, Gavin, all of their friends, all of these taxes that just, I got to tell you, it's really brutal because most people call me and say, you know what, I was going to just take the hit, but my CPA said, give you a call just to find out exactly how it works. And once they talk to me, they go, God, I thought I was only going to pay 15%. God, I thought I was only going to pay 20%. Now that I know that it's within this 30 to 40 percentile, there's no way I'm giving them all that money in taxes. I have to reinvest it into something. But what's available out there? What can I do? And then I let them know that, you know, you don't have to buy another single family home. You don't have to buy another condo. You don't have to buy another warehouse. You can do a lot of different things in a 1031 exchange. That's why the tool is so valuable. valuable. That's why it is so popular. That's why so many people over the years, I've been doing this for 25 years, and I got to tell you, I still get the same questions every day. I was told to call you. I'm selling my farm. I don't want to buy another farm. I'm sick of almonds. I like to eat them, but it's just not fun doing. And I tell them, hey, you could sell this whole almond farm and buy some property that's completely passive, and it no longer has to do with you working the farm. And people are just floored. And this isn't only the investors, this is the real estate professionals involved within the transaction. So when there's doubt or when you don't know, I think the best thing to do, and this is what I tell everyone, if you have an investment property with significant gains and you're not happy with that investment property, or maybe you just want to look at that property and reanalyze it again, it's always good to call me just so I can let you know what the options are. And if it's for you, great. If it's not for you, great. It's just good to know what your options are and what happens if you do something. Because I've had people call me after the fact saying, I should have listened to you. I should have asked you first, and it's too late. So it's always best to consult Coco. Coco can put you in touch with me when you have a property that you're considering unloading, just to know what your options are. And if it's for you, great. Today, if it's for you tomorrow or never, it doesn't really matter. We just like to answer questions and see where that sorts people. So let's go through an example, and then I want to go through some of the recent things that have happened within the code and give you guys an economic forecast on 1031s. So let's just say you're one of those people that owned a single family home. Maybe it was your primary residence back in 1975, 1985, 1990, whenever it was. It was the first one you bought, but you moved out of it. Rather than selling it, you turned it into an investment property. And it's been an investment property for 20 or 30 years, and it's got all kinds of appreciation. You listen to the message today and you go, you know what, Coco, James is right. This property has been so many different headaches, and I'm just tired of it. I want you to list the asset for sale, and I'm looking to put this into a Delaware statutory trust that's completely passive type of investment property. Please list the property for me. Coco lists the property for you. This is our example, and she gets it into contract. Now, I think the consultation with me should take place prior to putting the property on the market, just because it'll be a 5-minute conversation to make sure you qualify for the 1031 exchange and make sure you know how. Once you're in contract, the next thing you would do would be to open up escrow. And then the following thing that should be done is to give me a call and let me know you're ready to open up the 1031 exchange. Because I got to tell you, I get calls every week. No joke, no lie. I get calls every single week where somebody says, hey, James, I was told to call you to do a 1031 exchange. And I tell them what I need in order to open it up. And they say, well, we have the money. What do I do now? And the reality is you pay your taxes, because the 1031 exchange account, what we do as a qualified intermediary, that's what I do, has to be in place prior to the close. Our legal documents have to be in place and signed, and to escrow and to the seller, and everything in place prior to the close of escrow. If that does not happen, you are now a taxpayer, and there is nothing that you can do to salvage this transaction. So again, Coco lists the property for sale. You get an offer, you accept an offer, you open up escrow, I get into the mix. In order to open up the 1031 exchange, we'll need 2 items. Number one, we'll need a copy of the sales contract. And the reason why we need a copy of the sales contract is because we assign into the rights of the contract and actually act as the seller. We have to, so that the seller doesn't touch money. If the seller touches money, they're a taxpayer. So we set up a 1031 exchange account in their name. Now, the second item we need after the contract is the preliminary title report from your escrow officer. And the reason why we need that is because it will show who the owner of the property is. Quite often I talk to people and they say, yeah, I own the property. And I find out, no, you don't. Your trust does, or your LLC does, or your corporation does, or you own it with others, or something, right? And so we want to know who the taxpayer is that owns and operates this investment property, because that is who needs to do the 1031 exchange. And sometimes there's multiple owners, and sometimes it's easy, and sometimes it's more challenging. Again, in the initial conversation that we have, those are the kinds of questions that I'm going to ask to make sure that there'll be no problems later. But once we get through that hiccup, and let's just say it's a seller. Let's just say it's me. James is the seller of this property. Coco's selling my property. Got it into contract. I opened up escrow. I don't know if Richard Chen is on this thing, but he usually does all of my escrows. And Vicky.
He just got off the plane and he's driving to an appointment, so he's not here.
Shame on him. But let's just say we open it up with them to do the to do the escrow, and I get all my paperwork in place, and escrow closes. So at the close of escrow, the closing costs will be paid. The loans, if there are any loans on the property, will be paid off, and the remainder of the proceeds will go into the 1031 exchange account. Let's say the property is sold for $1 million, and let's say there's a $400,000 loan on the property. The $400,000 loan on the property will be paid off. The closing costs will be paid off. We're not going to look at closing costs because we're going to make it easy. And so let's just say the loan is paid off, $1 million sales price, $600,000 in proceeds will go into the 1031 exchange account. At that point, at that close of escrow, the clock starts ticking. And now these timeframes that I mentioned earlier commence. You have 45 calendar days to tell us in writing as the qualified intermediary exactly what you're going to purchase. And the IRS doesn't play games. There is no extensions when it comes to the 45 and 180 day time frame. Or is there? We'll talk about that later. So from the close of escrow, 45 calendar days, meaning every single day, even Saturday and Sunday and holidays count. And you need to identify to the qualified intermediary, that's what the company I work for is, IPX 1031 Exchange. And in writing, you will list the exact property address. You got to be careful with as well, because if you are listing a property address, and I got to tell you, I've seen this happen over the years. For example, I had one client years ago identify in writing to us prior to day 412 Maple Street in Livermore, California. That's what they were going to buy in the 1031 exchange. On day 60, we finally got a copy of the contract, and it was 213 Maple Street in Livermore, not 312. And I had to call the client and say, I'm sorry to tell you, but you identified 312, you're in contract with 213. You obviously transposed the numbers, but right now you're in a situation where you can only close on the one that you identified to us. And the client said, but that's not what I meant. I go, well, the IRS unfortunately doesn't go off of what you meant. They go off of what you identified in writing. And they asked me what they could do. I said, well, the only thing you could do is you could door knock the one that you identified and hope you could convince the seller to sell that property. So I want to make it crystal clear that you need to identify within the 45-day window. You need to double check what you identified and make sure what you're identifying is correct. If you're going to identify and purchase only a percentage of the property, you need to list that percentage. You can't put the property address and you're buying with somebody else and only buying a 20% or 30% or 50% interest. You would list the percentage. If you don't list it, we assume that you're buying 100% of the property. Now, you're also limited in what you can identify and how you can identify. And here's what I mean by that. Number one, you have to identify something within the United States or most U.S. territories. You can't go outside of the country. When you're selling domestic property, you have to buy domestic property. If you're selling international, on another tangent, you can buy international property, but that's something that we're not talking about today. We're talking about domestic property, 1031 exchanges. You also have to follow one of the three rules. Now, when it comes to identification, I said you have to identify to us in writing prior to midnight on day 45, but you have to follow one of the three rules. First rule, and the most popular rule, is called the three property rule. The three property rule, it says you can identify, the IRS says, you can identify up to three properties of any value. So it could be a property for $5 or $500 billion. It doesn't matter. What matters is you can only identify three, no more than three. Don't have to identify three. That's just the maximum that you can identify in a 1031 exchange. Up to you, but only three. And you could change that list as often as you want within the 45-day window. But come midnight, day 45, those three that you identify, those are the only three that you can move forward on. That is the three property rule. Second rule, 200% rule. This says, okay, what did you sell the property for? In our example, you sold it for $1 million. 200% of 1 million, you get that gross sales price, multiplied times 2 is 2 million. This rule says you can identify as many properties as you want, as long as all the properties you identify combined do not exceed 200%. To me, this is the rule that's used for somebody that's looking to probably buy out of state and probably buy a bunch of smaller properties. So using this rule, you can identify a bunch of smaller properties. Using the three property rule, you're probably going to be identifying 1, 2, or 3 large properties. And then if you're a gambler, anybody, Coco, you a gambler?
No, I'm not a gambler.
Okay, then you won't like this rule, but for the gamblers out there, and I got to tell you, my game of choice is Pai Gow Poker because I know that you can push that all night long. Not the dominoes, just the regular cards. So for the gamblers out there, you will like this rule, and this is how it works. You can identify as many properties as you want. No limit on the number of properties that you can identify. No limit on the value of the properties that you identify, unlike the 200% and the 3 property rule. Here's the kicker. You need to close on 100 or on 95% of the value that you identify. The reason why I call it the gambler's rule, that if you do not close on one of the properties that you identify, more than likely the entire exchange will fail. I did a 1031 exchange for a client probably about, God, it's got to be over 20 years ago, and they sold for $3 million in San Francisco. They identified 10 out-of-state properties, $1 million each, and they clearly exceeded the 3 property rule when it was 10 properties they identified. Each property was $1 million, so that's $10 million of real estate that they identified, exceeded the 200% rule. They were left with the 95% exception. They closed on 9 properties, and they fought on the 9th property. Same seller for all 10 properties. And because they fought on the 9th, the seller said no to the 10th. They closed on 95% of the market value that they identified, and the entire exchange failed. That's why I call it the gambler's rule, because you're taking a big risk using that rule that if you don't close on everything, more than likely the entire exchange will fail. Now, you have to buy like-kind property in a 1031 exchange, and most people hear like-kind property, and here's what I hear all the time. They call me up and they go, you know what, James, I'm selling a triplex. I'm doing a 1031 exchange. They told me I need to buy like-kind property. And my tax advisor told me I need to buy another triplex, but also to call you to make sure that that's correct. And I don't want to do that, so I'm just going to cash out. I go, hold on. You don't need to buy another triplex. All you need to do is buy real property that's used for a business or investment purpose anywhere in the United States. So that could be bare land, that could be a condo that you rent out, townhouse that you rent out, duplex that you are renting, a single family home that you're renting, a 20-unit building, a 400-unit building, an office building, an industrial building, a retail shopping mall, a church, a hotel, a vineyard, a farm. Cemetery plots qualify as well. Billboards qualify as well. Leasehold interest, as long as it's 30 years or longer, qualify. There are a lot of things out there that qualify for a 1031 exchange. So when you hear like kind, again, just ask yourself 3 questions. Is it in the United States? Check. Is it real property? Check. Is it going to be used for a business or investment purpose? Check. And even sometimes when the ultimate goal is to turn it into a primary or a vacation home, you could do that through the exchange as long as it's used as an investment property initially, and then the conversion can take place a little bit later in time. So I got to tell you, when you hear like kind, do not be fooled by it. You tell me, again, what do you want to do? What don't you like about this property? And I'll let you know how you can achieve that goal, preserve all the equity, and do that all through the 1031 exchange. So you have 45 days to identify, and from day 45, you have an additional 135 days to close on what was identified. As long as you use all the cash that comes in and buy of equal or greater value, you're in a position to pay absolutely 0 in capital gains tax. So this is huge when it comes to a 1031 exchange. I don't like this property. I want to get into something else. I don't want to pay capital gains tax. How do I make it happen? You follow that recipe. Now, a lot of people call me and they go, James, okay, this doesn't make sense to me. I bought the property years ago for $200,000. It's worth $1 million today. I'm doing a 1031 exchange. I put $100,000 down when I first bought that property. Now you're telling me to pay no tax. I need to buy something for $1 million. Why? Why am I not just reinvesting the equity that's coming out? Or why am I not reinvesting just the gain portion? And why can't I get that $100,000 original down payment money back tax-free? And I tell them, these are great questions, but unfortunately, I'm going to tell you how it works, and you're not going to like my answers. And if you don't like my answers, you can complain all you want to me, but it's the IRS that made up these answers, and you're not going to win a battle with them. So number 1, what do I need to do in order to pay 0 in capital gains tax? You need to buy of equal or greater to what you sell. If you're selling for $1 million, you want to buy something for $1 million. Yes, you can take out closing costs, but we're not talking about closing costs today. So let's just look at round numbers. Sell for $1 million, buy for $1 million. Now we had a $400,000 loan on the property that gets paid off at the close of escrow. That is correct. And you have $600,000 in the account. That is correct. You're not just reinvesting the equity, you are reinvesting the equity and replacing the debt that was paid off. Now, to get to $1 million, either you're going to get another loan to replace that $400,000, or you're going to come in with cash to replace that $400,000, or a combo of the two. Either way works, but you need to hit that $1 million number, and you need to use all $600,000 in the account as a down payment to avoid any taxes. Can you keep some of that money? Absolutely. Any money you keep is going to be taxable, though. And that's where people go, wait, this makes no sense to me. I came in with $100,000. Why is that $100,000 taxable? And I tell them, that $100,000 is not taxable. Okay, well, then send it to me. Well, I'm not sending you that $100,000. The IRS says if I send you $100,000, or if escrow gives you that at the close of escrow, that's not the original $100,000. That's $100,000 from the gain. And then usually the client says, no, it's not. It's my $100,000. And I say, well, the IRS says different, and the IRS is going to win that battle. So unfortunately, the original deposit money, if you want to get it out, I would recommend refinancing, doing a cash out refinance at least 6 months prior to listing the property to get that money out, or do it after you buy the replacement property. If you take it at the close, still okay, but that portion would be taxable because they're looking at that as money taken from the gains. And unfortunately, it's not just the gain that you reinvest, unlike opportunity zones. That's what they do for opportunity zones. In a 1031 exchange, you only reinvest everything, not just the gains. But to be in a position to pay zero in capital gains tax, this is what most people do. They reinvest every dime that comes out of the sale, and they replace the debt, if there is debt, with new loans. Now, I mentioned right now, well, a couple of minutes ago, that you have 45 days to identify and 180 days to close. And I think this has got to be one of the biggest problems with 1031 exchanges. Okay, so as of this morning, there is an extension on day 45 and day 180 for certain people. We call these people, I don't know what to say about this, unfortunate but special people, or maybe unfortunate but special people if they qualify. So when I say there are no extensions in the 45 and 180 day time frame, I kind of, I didn't lie, but there really isn't, but there kind of is. I think that's what we call a paradox. So there are extensions in extenuating circumstances, and the IRS has to release a disaster relief notice that allows you to apply for an extension. So there's probably about, 10 to 12 extensions per year that exist when it comes to the 45 and 180 day time frame. We just received one in California this morning, and it was because of the severe thunderstorms, mudslides, and all of this mess that we've been going through for the last couple of weeks. Here's what I found really interesting about this. I had it up on my phone. I could read it. That's why I have the glasses on, because I can't read without the glasses anymore close up. But these are the areas that received an extension. Coco, I'll let you know. You'll be excited about some of these, but confused about some others. So I'll just read the ones off in Northern California, because we don't need to hear about the ones in SoCal. Marin, Mariposa, Mendocino, Merced, Monterey, Napa, Placer, Sacramento, San Joaquin, San Mateo, Santa Clara, Santa Cruz, Solano, Sonoma, Stanislaus, Sutter, Yolo, Yuba qualify for the extension.
Wow,
what counties did I not mention?
Yeah, I hear Santa Clara and San Mateo.
Yeah, that's why you were excited.
Yeah, exactly. So how many days are allowed as extension?
So we'll go over that in a moment, but I don't understand why Alameda, San Francisco, and Contra Costa County were not included. I live in Contra Costa. I work in San Francisco County, and I'm often in Alameda County. I thought we got hit just as hard, but there was no extension granted for those areas. So the extension works one of two ways, and it really depends where you are in your exchange. If your relinquished property closed prior to the date, which is January 8th. If it closed prior to January 8th, you can have an extension on your 45 and 180th day for 120 days or until May 15th. So you can have a significant extension on the identification or the closing period because of this. If you closed after the 8th, then it's not as long, but you still will have that extension on that 45-day window all the way to May if you need it. Now, you don't automatically get the extension. You have to apply for it. But if you're in one of those counties, there's no reason to believe that you won't get it. Here is the cool thing about the extensions. It's under a certain revenue procedure. Here's one thing about the extensions. We did get an extension for COVID back when COVID came out, but it didn't follow the revenue procedure. It was more limited, which really sucked, but that's just the way it is with the IRS. And they said they'd never give another extension. That's the first time we ever had an extension on a pandemic level. But for the one that just came, Coco, it followed the revenue procedure where you usually get like 120 days.
120 days from both?
Well, it depends when it depends. So you'd have to give me the exact example. If you close, it's not 120 days unless you close on a certain date, but the 120 days is calculated from the date the extension was given, which was January 8th. So if you're, let's say you closed in December or something and your 45-day period was coming up, you can get an extension all the way out till May 15th. Same thing with your 180th day, you can get an extension that far out. But if you, after January 8th, right, let's just say you closed today, and today's January, what are we, the 10th? So if you close January 10th, then your 45th day could go all the way out till May 15th. That's a long time to identify replacement property. So there is an extension in California. We haven't received that many in my career. We got some for the fires, but outside of the fires and one earthquake, and these are only limited counties. This is the first one we've had in a couple of years. Now in the Midwest, they get these all the time because of hurricanes, but this is just like this happened today, so it's kind of timely that we had the class on 1031 exchanges. So if you're on the call right now and you're like, oh my God, just my luck, I was selling in Alameda, San Francisco, or Contra Costa County. For those people, I would follow up with two other questions. Do you live in one of those counties that I mentioned earlier, like Santa Clara, San Mateo, or Marin County, or Santa Cruz, or any of the ones that I mentioned? If you live in those areas, you also get the extension. Or if you work, you have a business in one of those areas, you also get the extension. So it's not just the property, but it's also if you live in those areas, you will receive that extension as well. So even though it may be in one of the counties that did not receive the extension, you may have the opportunity to get the extension depending upon where you live or where you work. So fresh off the newspaper grid, that's the latest and greatest in terms of extensions, which you don't get, but you kind of do when something disastrous does happen. Any questions on that? If anybody is actually going through that?
Yeah, I do have some questions regarding your identification. You have three rules, either three properties or 200% value or the Scambler rule, right? So you have to close up to 95% of the value you identified. So tell me why people would choose. I know people choose the three property rule for, like you mentioned, for bigger value for each property, right? So, but for if you're buying out of state, you choose the 200% rule so that you can choose multiple properties. But why would people choose this 95%, the Scambler rule?
In my career, let's say you have a client that really wants to over leverage on replacement properties and it's going to exceed 200%. That would be the only way to get it done. But again, I'd like to reiterate, if you're going to use that 95% rule, ideally have everything close within the 45-day window so there is no risk. If it is not going to close within that time frame, just make sure everything you're in contract for or everything that you're looking to get into contract for, you can get into contract and you can't close. Otherwise, it would jeopardize the exchange. So I've been doing this. In July, it'll be 25 years, and I've probably helped over 50,000 transactions, people with 1031 exchanges, me and my team. And I've seen the 95% exception where you're past day 45. In other words, you're really at risk and you're really gambling. I've seen it go through successfully, maybe that I'm aware of, about 10 to 12 times. So, Coco, to answer your question, this is not a rule that I want anybody to consider without the proper consultation from me. And I want to make sure that they understand that once you're past day 45, now you're really at risk. If you don't close everything, you're probably going to pay taxes. You're probably going to fail.
Unless you get your extension for another 120 days.
Well, you still have to close on what you identify. So you're going to get you could probably, you're right. So if you got the extension, then you could use that rule, but you could change it all the way up till May 15th. So, we don't want to tell people that. Just wait for the next disaster and you'll be okay.
Are you saying that the closing within 180 days, now it can be, if it's closed before January 8th, it can be 180 days plus 120 days, right?
No, I'm saying that
Closing?
let's say your 180th day was on January 13th. You have like 3 days left. Well, you could file the extension and get it all the way to May 15th.
Oh, so May 15th is kind of the deadline, but
yes.
So the 45-day extension and also the 120-day extension, they are both.
No, it's the 45 and 180 day that gets the extension. The extension is going to be that 120-day time frame between January 8th and May 15th. It'll really help out people. I mean, to me, it's like if my 45th day was January 10th and I didn't have anything, I'm going to love this. Mm-hmm. Because I'm going to have an additional 120 days to identify something. Or what about the person that says, I'm ruined, I'm done. I identified a new construction property and it's not going to be completed by day 180. Then magically I get this extension and I have all the way till May 15th. That person's going to be very, very happy.
But that is what you have May 15th as the deadline, right?
For the people that qualify for the extension and apply for it, yes.
Okay. And then back to the gambler rule, the reason I was confused is because the reason we do a 1031 exchange is because we try to postpone this capital gain payment for the taxes, right? So if I only have this much gain, why would I identify so much higher for the value? I can just identify enough to help with my capital gain taxes instead of.
Well, you got to look at it like this. If I have a property that I bought in Santa Clara County back in 1980 for $300,000 and today it's worth $5 million and it's free and clear, and I don't want to buy everything all cash. Maybe let's say the interest rates were really low, or I could get into something that had favorable financing. I might want to leverage, but I also want to diversify. So maybe I'm buying multiple properties and maybe I'm leveraging to buy into, I don't know, $12 million worth of real estate, $15 million worth of real estate. So it's not a very common rule, Coco, but in certain scenarios, it really works out well. And maybe it's small numbers, right? I have $300,000 in cash. I sold for $300,000. It's free and clear. And I want to leverage into $1 million worth of real estate in Fort Worth, Texas. And the 200% rule is not going to work for me because $1 million's more than that. And the 3 property rule is not going to work because I'm going to buy more than 3 properties. So depending upon the strategy of what somebody does and how much equity they come out of it, that's what usually dictates using that 95% exception. And there is no risk on that rule if I can complete it really quickly. It's once I'm past day 45, now I can't change it. And if I don't close on everything, well, then I'm in a real bad position and my exchange could fail.
Got it. Okay. So I have 2 quick questions from the audience. If you don't mind, I'm just going to.
Yeah, and then I'll jump into a couple of different things that I think are important to mention.
Okay, great. So just going back to the 120-day extension, that's for both identifying and closing together, right? That's from one audience. And I think we talked about that, but I just want to clarify the May 15th still being the deadline, meaning that.
Yeah. And if somebody is, in Coco, if somebody is really interested in that, I can email them a PDF on it with all the appropriate forms, because like telling it over a Zoom can be a little bit confusing, or they can contact me directly. But to have the form and the IRS ruling on it, it kind of explains it pretty thoroughly.
Okay, if you can email me that form.
Yeah,
and
yeah, I'd be
anybody
happy to
who's-
do that. We just got
Yeah.
that today.
That's great. And anybody who's interested in this form, you can contact me, and then my team will drop my email in the Zoom chat, and then you can email me. We can get you the form.
Coco, I didn't even think about that, but that might be a great reason for somebody to sell their property right now, where they know, well, if they're in one of those counties, then they know they're going to have more than 45 days to identify something.
Oh, all right, sounds good.
I mean, I didn't even think of it like that, but I know that a lot of the time people don't sell their property because they're like, I'm not going to find anything in 45 days, not for what I want. Well, wouldn't it be cool if you knew you had more than 45 days? So, I don't know. That's just a thought out there that I had never thought of until this very second.
Okay, that sounds good. Two other questions. That identifying three properties mean I have to buy all three? I have the answer.
No.
No, you don't have to buy all three. You can buy any of the three, or
Correct.
two of them, or three of them. Yeah.
Yeah, you can buy one, two, or three of them. You just can't buy a different property. It's only the ones that you have identified.
Right. And you mentioned about overseas. So somebody's asking, 1031 restrict to properties inside US. Can someone do a 1031 between a house outside of the States and a house here in the Bay Area?
No, it's got to be domestic for domestic. The furthest you can go outside of the States is U.S. territory, and only Guam, U.S. Virgin Islands, America Samoa, and Northern Mariana Islands, for whatever reason, Puerto Rico is not included. They've never given us a reason why. They just have not included it, but those would be the U.S. territories that you could invest in. Otherwise, unfortunately, you can't go anywhere else.
Okay, sounds good. So sorry for the interruption. Why don't you go back? And
I love interruptions. So as much as people want to hear something different, because I never know what people want to hear about, feel free to do that. So I think we're very crystal clear on what you can buy in a 1031 exchange. I think we're aware of the deadlines, and I think we're also aware of replacing the debt and using all the cash in a 1031 exchange, why we do it, what it is. But I think some of the questions that come up right now, and what we had a lot of in 2021 and 2022 is, can I buy the property that I want to purchase in my exchange first and sell my property second? Because there's no inventory available, or I want a specific property in an area and I don't think I'm going to find it in 45 days. And the answer is yes, you can do a reverse exchange. Now, a reverse exchange is very popular in 1031 land. And a reverse exchange is where you buy the replacement property first and sell the relinquished property second. Now, not everybody can do a reverse exchange, because most people, I mean, in my opinion, most people are going to be using the money from the property that's being sold in order to purchase the property that's being acquired. In a reverse exchange, you're buying first, you haven't sold that property. So my question to anybody that wants to do a reverse exchange is, how are you going to buy that property first? And sometimes they say, well, James, I thought you were going to buy it for us first, and then we would sell ours. And that's the reverse. No, the qualified intermediary does not buy the property for the buyer. The buyer buys the property first, but the buyer does not go on title at the close. The qualified intermediary, the exchange company, will set up an LLC that will go on title at the close. And from that close date, you will have 45 days to identify what you're going to sell and 180 days to close it. So here's how it works. You know that you are going to buy the property first. A, maybe you still have tenants in the property you're selling. B, the property came on the market that you just really, really want. Or C, it's just in an area that has no inventory and you're going to sell your property once you're able to find one, but you know it's going to have to be a reverse exchange because there's no way you can close your relinquished property prior to the purchase. So you would go out there looking to do a reverse exchange in most cases. Sometimes it happens accidentally, and I'll explain that. You go out there looking to buy the property first. You get into contract. You open up escrow, and again, I get involved in the mix at that point. I'll need, again, a copy of the purchase contract because we will assign into the rights to become the buyer. And we will need a copy of the title report because we will use that information in order to put our documents together. But here's the difference on a reverse exchange. We will set up a limited liability company, a single member LLC, that will go on title to the property at the close. So the actual client, the principal, the owner of the property is not on title to both properties at the same time. Can't do that. You can't exchange with yourself. So you can fund the purchase where we set up the LLC that will go on title at the close. And then from that close date, you'll have 45 days to tell us what property you're selling, which is usually easy unless you have multiple properties that you own, and 180 days to close. Now, here is the difficulty, because when people hear that, they're like, Well, that's what I'll do. I'll buy first, sell second, easy peasy. Because I'm selling a property in Santa Clara County. And even in this current market, if I price it right, it is going to sell. Here's the problem. If you don't have the cash to buy the property first, then you're going to have to get a loan. So let's go over the easy scenario first. You get into contract to buy the property, open up escrow, you call up James, the paperwork gets set up, we set up the LLC, you bring in cash to escrow at the close, and you close in the name of the LLC, and then you have 180 days to sell the property that you're going to identify to us within the first 45 days. And when you sell that property, the cash that comes from that property will go back into your pocket and you're done. And you go on title to the one that you're going to be purchasing, or you take over the LLC on an all cash purchase where you have the cash and the ability to do this. Very easy. Now, let's say you don't have the cash. You have enough for a down payment and you're going to get a loan for the rest. If it is a residential piece of real estate that you're looking to purchase, most, if not all, outside of First Republic, conventional lenders will not lend to the LLC. What does that mean? That means that you're going to have to find a different source of financing. What are your options? Your options are private money, which will probably charge you about 2 to 3 points, so it's a lot more expensive. Or you could ask the seller if they're willing to carry. That would be ideal as well. But in most scenarios, you're not going to find a seller that's willing to carry, and you're going to have to go private money. So the fees, if you're getting $1 million of financing, that's $20,000 to $30,000 in points that you would be paying in order to secure this type of loan. So it could get quite expensive on the private money level, but it will work for a reverse exchange. Now, if you don't have the cash and no type of financing will work for you, the reverse exchange is not an option. You need to find the money to buy first. Now, it's just temporary, but then people say, wait a minute, James, the market's changed a little bit. What if I don't sell my property? How much taxes do I have to pay at that point? And I tell them, you don't pay any taxes. Well, why not? I don't understand. Well, you haven't sold anything yet. Well, what's the problem with that? Now you own 2 properties and you can't exchange into the one that you just purchased because that reverse exchange opportunity is gone. And they're like, oh, don't want to do that. So you want to make sure you can sell your property in 180 days. You want to make sure you're in a position to buy it first. If it's all cash, it's very easy. If it's not all cash, you want to make sure you have a lender that's on board, or else this is not going to happen. So I love the reverse exchange to find that ideal property in a market with limited inventory. Or get this, I've had many people, they're selling the relinquished property. It's in contract. It's good to go. And they're buying a replacement property. They're both in contract at the same time. And there's no problem with that. But what if the relinquished property falls out of contract? Coco, maybe you can answer this question. If I'm in contract on a property that I'm selling, and I'm in contract on a property that I'm buying, and the property that I'm selling, we're looking to close on January 13th. And the property that I'm buying, we're looking to close on January 31st. There is no backup offer. And for whatever reason, the property that I'm in contract to sell, it goes out of contract. Am I still in a position where I have to purchase that replacement property or lose my deposit money?
If you have a sale contingency, of course, then because your sale didn't go through, right? Then you can actually back up from your purchase. But if you don't have a sale contingency, I think you can still try to work with the seller and saying that I'm still going to buy your property, but I have to sell my home, so maybe you can give me more time to work it out.
And if they say no, we're probably in a bad situation.
If they say no, well, you still have, January 13th versus January 31st, you still have about half a month. So we can quickly, right now only January 10th, right? So can still try to sell the property quickly. And then
so I love how Coco is just trying to find ways through this, but the point of the story is sometimes a reverse exchange is needed because for whatever reason, the relinquished property can't be sold in time because it fell out of contract. Most reverse exchanges are done because they are looking to buy first and sell second. But sometimes, unfortunately, a property could fall out of escrow, and that happens from time to time. And there is not a contingent offer in place, and they're kind of gambling in a situation like that, Coco, right? At least gambling for their deposit money.
Yeah, well, in the seller's market, of course, a lot of people like to do reverse exchange because selling is not an issue, but buying is an issue. But right now it's more balanced market. So I think maybe to do the forward exchange is better.
I completely agree with you. Unless You have tenants in there and you don't want to lose the opportunity on a good property where you don't have enough time. I love the reverse exchange in the right market, like Coco said, or in the right circumstance when needed. So I think it's a great tool that is available, but for the right person, it will work. And for if you don't have the money to make that happen, and you're asking in some scenarios, I have to buy something for $3 million, $2 million. It just isn't feasible. A traditional exchange will work just as nicely for you. The last thing I did want to mention that I think is very popular now and very popular just 1 to 2 years ago is you have somebody that sells a property for $1 million, as an example, doing a 1031 exchange, looking for a lot of different properties, and maybe they find the perfect property, and the perfect property is only worth $800,000. So there's two things to look at here. Number one, can I still do the 1031 exchange when I'm buying down in value? The answer is yes. You can always do a 1031 exchange and buy of less value and just pay tax on the difference. So let's say I bought the property originally for $200,000. I'm selling for $1 million. I found something for $800,000. That's the property I want. I know it's of less value. Can I do the exchange? Yes, you can. You're not going to pay taxes on 600,000 of the gains, only on 200,000 because you're buying something for 800,000. Could you buy a second property to make up that difference? Absolutely. But what if you don't want a second property? Is it okay just to take the hit? Absolutely. Nothing wrong with that. But what about this? The property you want to buy, perfect property, but you want to build an ADU. It needs some work as well. Can I use that money from the sale to improve the property that I'm going to purchase? Number one, improvements don't qualify. It's not real property, but there is a way around it. So the improvement exchange became very, very, very popular during a time where there was limited inventory and people wanted to improve the property that they were going to acquire. Here's how it works. Sell the property for $1 million, set up the 1031 exchange. We're all over that. We have everything in place. You identify the property that you want to buy for $800,000, but you also identify the improvements that you want to have done within the 180-day time frame. Now, I already told you improvements don't qualify. Real property does. So the way around it is we as the exchange company, just like a reverse exchange, will set up an LLC so that the actual principal, the owner of the property, does not go on title at the close. The exchange company goes on title at the close. While we are on title, the improvements can get done. So the way it works is at the close of escrow, the LLC will go on title to the property. The general contractor, the subcontractors will invoice us directly. We will pay. And remember, if there is a loan involved, the lender is going to have to be okay with the LLC. But if it's all cash, it's very easy. We will pay the subs and the GC when the invoices come through for work to be rendered. The problem is you need to get the work done within the 180-day time frame. But I had many people that would get an ADU done, rehab the entire house for things that needed to be done, roof, kitchen, bathroom, and spend all that money. And if they could spend all that money within that time frame, not only do they not have to worry about that $200,000? They have a completed property, the ideal property, in an area that they want for the price that they were looking to get to, an equal or greater number, and pay zero in capital gains tax. So the reverse exchange and the improvement exchange, very, very, very popular for the client that is looking for a specific property or looking for a property that needs improvements. And it could be, we've had a lot of clients that that's what they do for a living. They are contractors as well, and they find properties that need a little bit of work, and they fix them up with the exchange proceeds, treat them as investment property, and down the road when they sell them, they 1031 exchange them again, and they have added value to that. So the improvement exchange and the reverse exchange, very, very popular.
So James, for the improvement exchange, the lender would approve the improvements? I mean, for ADU, understand?
No, the lender would have to be okay with the LLC going on title at the close. That's the issue with the lender, just like the reverse exchange.
So it sounds like it's either private money or just...
Or hopefully an all-cash purchase.
Yeah. Or maybe like construction loan?
Yeah, as long as whatever lender it is good with that. There's no issue. And it happens more often than you'd think. I actually had a guy do an improvement exchange and built a whole property. Now, obviously, this wasn't in the Bay Area because permits and all of that, they did it out of state. But they were really happy when they completed their transaction. They sold out here and built what I think is eventually going to turn into their dream home.
Got it. Okay. There's a question I don't think really related to the exchange, but I think they're just asking if a property somebody lived there as owner occupied for 1.5 years, and the rest of the half year they went for traveling all over the world, so nobody living there. So when they sell the property, I guess no, it's really not an exchange question, but I guess if do they actually have to qualify this as an exchange to buy something else, an investment property? Or
I would still try to qualify for the primary residence exclusion in that scenario. What they would look for is on your tax returns, what are you claiming as your primary residence? Now, if we flip that question and say, okay, we owned it for 1.5 years and then we decided to sell it because we were going to travel across the world. You're not in a good situation there, because they will let you get a prorated share of the primary residence exclusion when you have a good reason. Leaving the country to travel would not be a good reason. A good reason would be a hardship, a work transfer of more than 50 miles, an unplanned birth. Unplanned birth means twins, triplets, not like we didn't want to have another baby, just in case anybody here was thinking that, oh yeah, we didn't plan to have the third child, but it just happened. No, that's not the reason. It's got to be like twins or greater. Okay. And we have seen that happen. I've had people call me up and say, you know what, we had triplets. We didn't plan for this. The house is too small. Do you know of anything? I go, yeah, you can get a prorated share of the exclusion. You've been there for 1 year. You can get 50%. That's $250,000 of your $500,000 exclusion. So depending upon the circumstance, to answer your question, Coco, you could get a prorated share of the primary residence exclusion, potentially, but there would be no 1031 opportunity there.
Got it. Okay, sounds good. Yeah. Wow, looks like time flies when we are having fun.
Yeah, so, we're 6:30 on the dot.
Yeah. So let me take one last question. Can you elaborate to what kinds of passive investment property?
Sure. I would say there's multiple types of passive investment property. They're all commercial types of investment property. I'd say you have different types of commercial investment property, and I'm going to go over 3 very quickly. The first one would be like, okay, I'm going to sell my investment property, do a 1031 exchange, and buy into like a Burger King or like a Dollar General or like a Walgreens, right? So I'm buying into an asset where I'm buying the building that is being leased by whomever. In the examples I gave, it was Burger King, Walgreens, Dollar General, and they have a long lease on it, and their lease is triple net, meaning that the tenant will pay your property taxes, the tenant will pay the insurance, the tenant will take care of all the improvements, the tenant is responsible for everything. If you are going to do something like that, I'd recommend that you get a tenant that has a corporate guarantee, like a Walgreens or like a Burger King or like a Jack in the Box, or like somebody that if they close that shop, the corporate guarantee is still going to pay. The longer the lease, the better the investment for that type of passive investment property. The second would be a Delaware statutory trust. This is very, very popular, and this is where you would own a fractional interest in a large commercial institutional property, and you do absolutely nothing except get a check each month. As an example, you would own, let's say, a 1% interest in a $120 million 500-unit apartment complex that was just recently constructed in 2022 in Oklahoma, for example, in an area that's up and coming. And you'll just get paid each month on that. Or another example would be you buy into an industrial property owning a 1 or 2% interest. And people go, industrial? Why would I want to do that? Well, it's a warehouse and the tenant is Amazon. And when they hear that, they all want to buy a piece of that. So those are very popular. There's all kinds of different examples for that. And those are very passive types of investment property where you don't deal with anybody except getting paid each month and take advantage of the tax credits. And the last one would be an UPREIT program. People always ask, can I buy into a REIT when I'm doing presentations? And a REIT is a security, not real property. But you can get into a REIT if you want to through a 1031 exchange. You would do a 1031 exchange into the DST, like I just mentioned. So you're going to buy into the DST. whatever investment DST opportunity is out there. But this particular DST investment opportunity is on a schedule within the next 2 to 3 years to be absorbed by a specific REIT. And then you will go into the REIT, and then you are stuck in the REIT. And if you sell, there's no more 1031 opportunity. So the three passive types of investment opportunity is just a standard commercial property that's triple net leased, a DST, Delaware Statutory Trust opportunity, or the UPREIT program where you get into a REIT. Those are three good examples. If you want more information, you guys can always reach out to me.
I was always thinking that rental properties is considered as passive income, right? So I have this passive income. I actually do Airbnb. I mean, I don't do Airbnb myself, but I hire a property manager to do Airbnb. I invest $200,000 or $300,000 in a condo in Hawaii, and after my PM fee, after my HOA fees, after all the fees, my net income is $3,000 to $5,000 per month. I thought,
and those are very popular, Coco, and there's nothing with them. But when I think completely passive, I want something where I don't pay the insurance, the property tax, and the improvements on the property. So that is the difference there. Now, you're right. When you have a property manager handling something, it's more passive, but not completely passive, because you are still paying the insurance and the property taxes.
Correct, you're right. But for me, I'm very hands off. I just I found the right person, and I just received my check.
And that is a great, like I told you, there's so many different strategies. That's just one that is very popular. I do the same thing on one of my properties, and I love it.
That's wonderful. I take one last question. There's one question saying, after I do the 1031 exchange and bought the property, can I use this as my primary home?
You can, one of two ways. Number one, you're going to wait. You're going to rent it first, and you're going to rent it as long as your tax advisor recommends, which will either be 1 or 2 years. 1 being aggressive, 2 being conservative. If it's over 2 years that you rent before you convert, you don't have to ask your tax advisor. 2 years is fine. Or you're going to buy a mixed-use property where the investment portion of the mixed-use property is equal or greater to your target price, so you can move into the primary portion. Where does that apply? Well, let's say you sold something for $1 million, and then you went and bought a 4-unit building for $3 million, and you wanted to move into one of the units day one. You can, because the other 3 units combined are equal or greater to your target price. So depending upon the numbers, it doesn't have to be a 4-unit building. It could be a farm you're buying into, and the investment portion is equal or greater, or a vineyard, or there's a mixed use where there's a commercial store downstairs and you live upstairs. It really depends on the circumstance. And that will determine how quickly you can move into the property. It's either going to be right away if the numbers work, or you're going to have to rent it first and then convert it later.
So basically, after 2 years, you don't have to ask anybody, you can convert this into a primary home. So you postponed your capital gain taxes from the previous property.
Indefinitely, if you never sell.
Now it's a primary home now. You can actually get capital gain exemption from there.
A portion of it. It will be prorated if you look to cash out in the future, and you'll have to own it for 5 years. But yeah, you can protect a lot more when you convert it to a primary in the future. If anybody is interested in that strategy, please contact me. I'll let you know how it works.
That sounds great. Well, thank you so much, James. That's absolutely enlightening. This actually concludes our seminar, so we will end the recording now. And everyone have been unmuted. So let's unmute everyone, and please say thank you to our guest, James. And I will see everyone else at my weekend open houses or at my next 10 seminar.
Thank you, everyone. I really appreciate seeing everybody for the new year. Thank you, Coco.
Thank you.
Thank you, James. Thank you.
Thank you, James.
You're welcome. Thank you.